You know, when you watch a skyscraper during like a massive earthquake, it looks absolutely terrifying from street level.
Oh, yeah, completely.
You see the glass shattering, the facade is cracking, the whole structure is just swaying violently in the wind. And to the naked eye, it really looks like the building is failing.
Right. Your instinct as an observer is just to assume that structural collapse is imminent. You see the movement and you immediately interpret it as this fatal flaw in the design.
Exactly. But if you were to look underground, down in the foundation, you'd see something completely different. You'd see these massive steel rollers absorbing the kinetic energy. The core is holding perfectly firm.
Yeah, the swaying isn't a failure at all.
Right. It's the exact mechanism designed to keep the building standing. So welcome to the week that was. I'm your host, and today we are looking at a market that is currently shaking violently at the top floors, while the foundation is, well, quietly being reinforced with titanium.
It's a really profound divergence to analyze. I mean, we are watching short-term market panic just collide head-on with long-term institutional codification, and the underlying data really reveals this massive structural tug-of-war happening right now in the digital asset space.
Yeah, and that's our mission for this deep dive into the recent source material. We want to figure out what is driving that tug-of-war. We've got this massive stack of financial filings, legislative drafts, market flow reports.
A lot to get through.
A ton. And we're going to unpack how the gravity of traditional macroeconomics is violently pulling capital out of the system, while at the exact same time, corporations and sovereign governments are quietly installing this permanent infrastructure.
It's fascinating.
But to understand the digital asset market's recent downward pressure, we actually have to step away from the blockchain entirely, don't we?
We do, yeah. We have to look at physical world events and really legacy financial plumbing. Because the catalyst for this entire market contraction started with a geopolitical trigger. Specifically, a drone strike on the Baraka nuclear power plant in the United Arab Emirates.
Which sounds terrifying.
Yeah.
But just to remain purely analytical on the facts provided in the reports, air defenses intercepted 2 drones and a third hit an external electrical generator outside the interprotected zone.
Right, exactly. The UAE confirmed the reactor cores sustained 0 damage.
Okay, so no core damage. But the geopolitical shockwave was still immediate. The UAE blamed Iran, tensions escalated, and we saw warnings issued from the highest levels of the United States government. But for you listening, you might be wondering, how does a drone strike on a generator half a world away dictate the price of a digital asset on your phone?
It's a fair question, and it all comes down to energy.
Okay.
When the Middle East destabilizes, energy markets react instantaneously. I mean, we saw Brent crude oil futures spike, clearing $111 per barrel.
Wow.
Yeah, and West Texas Intermediate crossed the $107 threshold.
Which is a massive jump when you consider crude was trading near, $70 earlier in the year?
Exactly.
But oil spiking doesn't automatically mean investors just go out and sell digital assets. What's the mechanical link there?
Well, elevated energy costs essentially guarantee elevated inflation data. Just think about the physical supply chain.
No.
When oil prices spike, the cost of diesel fuel goes up. That means the cost to, say, harvest a tomato, load it onto a refrigerated truck, and transport it to your local grocery store, all of that increases.
And that cost just gets passed on to the consumer.
Right. When everyday goods become more expensive, your inflation metrics rise.
And when inflation metrics rise, the bond market gets very nervous.
Nervous is definitely an understatement. And compounding those inflation fears from the oil spike, Moody's actually downgraded the United States sovereign credit rating from A0 to AA1.
Wait, let me stop you there because sovereign credit ratings can sound like a lot of abstract Wall Street noise. A downgrade from A0 to A01 basically means the credit agency is telling global investors, hey, lending money to the U.S. government is slightly riskier today than it was yesterday because they are spending more than they take in.
Right. That is the core message, yeah. And because the perceived risk increased, investors naturally demanded a higher return for lending that money.
Makes sense.
So the bond market went into this defensive posture, and Treasury yields spiked violently. The 10-year yield rose to 4.63%, and the 30-year yield surged to 5.2%.
Which are levels we haven't seen since, 2007.
Exactly. It's a big deal.
Okay, let me try an analogy here to see if I'm grasping the scale of this.
Yeah.
Think of the bond market, especially when yields cross that 5% threshold, as a massive gravitational force, or actually, better yet, a giant macroeconomic vacuum cleaner.
I like that.
When a portfolio manager can get a guaranteed, risk-free 5% yield from the United States government, Does that vacuum cleaner just mechanically suck liquidity out of zero-yield bearer assets, like Bitcoin, completely, regardless of how good the underlying technology is?
Yes. It is a purely mechanical rotation of capital. I mean, traditional fiduciaries manage trillions of dollars. When they look at a 5.2% risk-free yield, their mandate often legally requires them to de-risk.
Wow. So they don't even have a choice, really.
Not always, no. They pull capital from volatile assets that don't pay a dividend or a coupon, and they park it in treasuries. That vacuum cleaner effect is absolutely the primary causal driver for the market contraction we saw in the reports.
So if that is the macro vacuum cleaner turning on, how did that actually hit the market? Because looking at the data, the impact was immediate, and it showed up entirely in the exchange-traded fund flows.
Oh, the ETF outflows were massive.
Yeah. We witnessed this massive exodus from United States spot Bitcoin ETFs. Over just a 7-day tracking window, the cumulative capital flight approached $2 billion.
Yeah, we are talking about hundreds of millions of dollars flowing out of the BlackRock iShares Bitcoin Trust, the ARK-21 Shares Fund Fidelity. It essentially terminated a 6-week streak of positive capital accumulation.
I really want to get into the mechanics of this because I think a lot of people, myself included, kind of assume that when retail investors sell their ETF shares on a brokerage app, it's just numbers on a screen changing hands between buyers and sellers.
Right, like it's contained.
Yeah, but there is a physical reality to these redemptions that drives the actual spot price of the asset down.
The plumbing behind the scenes is actually fascinating. When a massive wave of ETF investors hit the sell button, the authorized participants, these are the specialized financial institutions managing the ETF creation and redemption process, they're forced to process those fiat redemptions.
Okay.
To give those investors their cash back, the authorized participants have to physically sell the underlying Bitcoin on centralized exchanges.
But they can't just take their time and wait for a good price, can they?
Yeah.
I was reading about the settlement cycles, and it seems like they have a ticking clock.
They absolutely do. The legacy stock market operates on a T+1 settlement cycle. That means trades must mathematically settle 1 business day after execution.
Oh, wow.
Yeah, so those authorized participants have rigid, totally non-negotiable deadlines to source fiat liquidity. To meet those deadlines without crashing the market all at once, they use specific algorithms.
Like what kind of algorithms?
Often volume-weighted average price, or VWAP, algorithms.
Break down VWAP for us. What does that algorithm actually do in practice?
Sure. So instead of dumping, say, 10,000 Bitcoin in 1 second and causing a massive flash crash, a VWAP algorithm slices that order into thousands of tiny pieces.
Okay.
And it systematically sells them over a specific time period, trying to match the average price of the broader market. So it is a forced, indiscriminate, relentless selling mechanism.
And that relentless algorithmic selling is what drove the price action down, basically testing that $74,000 support baseline.
Exactly.
Which brings us to the collateral damage in the retail sector, the liquidation cascade.
Yeah, this is where it gets painful. When the spot price drops that quickly due to institutional algorithmic selling, retail traders who are using leverage just get caught off guard.
Because leverage multiplies everything.
Right. It allows traders to borrow money to multiply their potential gains, but it also multiplies their losses. When the price hits a certain threshold, the exchange automatically liquidates their position to cover the borrowed funds. We saw over $670 million in leverage contracts wiped out.
Over $500 million gone. I mean, there was one specific hour that produced a $527 million liquidation cluster alone.
It's brutal.
There was a single $36.78 million long position liquidated on the hyperliquid exchange. Just completely evaporated. But I have to push back on the traders here for a second.
Okay.
Why are people holding massive leveraged long positions during a period of obvious geopolitical instability and rising interest rates? It seems crazy.
Well, market participants often suffer from recency bias.
Right.
They had just witnessed a 6-week streak of ETF inflows and assumed the upward trajectory was just a permanent structural feature of the market. They totally failed to account for the macroeconomic vacuum cleaner we discussed earlier.
Speaking of failing to account for market structure, this whole sell-off prompted Mark Cuban to make headlines.
Yes, I saw that.
According to the source material, he sold 80% of his Bitcoin holdings because during this geopolitical crisis in the Middle East, gold went up, but Bitcoin went down. He basically stated it failed as a hedge.
His frustration is understandable, but it really highlights a fundamental misunderstanding of how market structure operates under stress.
How so?
Well, to understand why those two assets diverge, we have to understand liquidity. Gold is largely a physical market. It's heavily regulated, it has specific trading hours, and moving physical bars involves massive settlement frictions.
Right.
Bitcoin, on the other hand, is a continuous 24/7 liquid market.
24/7. There is literally no closing bell, and
Yep.
there are no weekends off.
Exactly. So during a global liquidity crunch or when major institutions are facing margin calls across various asset classes because the bond market is having a tantrum, they need cash immediately.
And they can't get it from gold fast enough.
No, they don't sell their illiquid commercial real estate either. They don't try to rapidly offload physical gold bars in a panic. They mechanically sell their most liquid, always open, perfectly frictionless asset.
So they sell the asset that is easiest to sell, not necessarily the one they want to get rid of the most.
Yes, they essentially use it as a 24/7 ATM to cover positions elsewhere. And that explains the immediate, seemingly counterintuitive price drop during a crisis compared to a slower-moving asset like gold. It is the invisible price you pay for perfect liquidity.
Okay, so that covers the top of the skyscraper swaying in the wind. We have the macro vacuum cleaner, the algorithmic ETF outflows, the leveraged liquidations. Now let's look at the foundation.
Let's do it.
Because while Wall Street algorithms were blindly selling for fiat liquidity, global governments were making permanent structural policy adjustments.
The divergence is staggering. I mean, let's start by looking at India. To offset the rising cost of crude oil we discussed earlier, the Indian government enacted a pretty strict measure of economic austerity.
What did they do?
They raised the import duty on physical gold and silver from 6% to 15%.
A 15% sovereign tax, just to bring the physical metal across the border. That's huge.
It creates immense physical and economic friction. Contrast that with digital assets. Bitcoin avoids port of entry taxation entirely due to its jurisdictional mobility. I mean, you cannot put a physical tariff on a private key memorized in someone's head.
That's a great point. And while India is heavily taxing physical gold, the United States is actively drafting legislation to integrate digital assets into its core plumbing.
Yeah, the ARMA.
Right. The source material outlines the introduction of the American Reserve Modernization Act, or ARMA. This bill proposes establishing a United States strategic Bitcoin reserve. And crucially, it mandates a 20-year lockup period for the assets.
With the explicit goal of using future appreciation to pay down the national debt.
Right. But a 20-year lockup completely alters the supply dynamics of the asset globally. If a massive nation-state begins warehousing a strictly scarce asset and legally prohibits itself from selling for 2 decades, the available float for the rest of the world shrinks dramatically. But is that actually feasible? Can a government just hoard supply like that without breaking the market mechanics?
It creates an artificial supply shock, which historically just drives the price up for everyone else trying to acquire it. But the legislative moves don't stop there.
What else is happening?
The executive branch drafted orders ending Operation Choke Point 2.0. That explicitly prohibits regulators from denying banking services to legal digital asset firms.
Oh, wow.
And they also mandated a 90-day review process for non-bank crypto firms to apply for direct access to the Fedwire settlement network.
Now, I know Fedwire is the ultimate backbone of the U.S. financial system, moving trillions of dollars. But what does giving a crypto firm direct access actually change on the ground for you or me?
Currently, a crypto firm has to use a traditional commercial bank as a middleman just to access the Federal Reserve's settlement system. That middleman adds fees, delays, and a lot of counterparty risk.
Okay, so it slows everything down.
Right. Direct Fedwire access means these digital firms could settle fiat transactions directly with the central bank. It removes the middleman entirely, essentially legitimizing the industry at the highest level of traditional finance.
That is a massive structural shift. And it's complemented by the Digital Asset Parity Act, right?
Yes.
Which aims to treat small stablecoin payments just like cash, completely eliminating the friction of calculating capital gains taxes every single time someone buys a cup of coffee with digital dollars. So the U.S. is clearly clearing the regulatory runway. But looking at the reports, Japan is arguably moving even faster. The Liberal Democratic Party launched Project Glasswing.
Yeah. Japan is essentially planning to run their entire future artificial intelligence economy on yen-denominated stablecoins.
That sounds like science fiction.
It does, but they are literally uniting their mega banks, specifically Mitsubishi UFJ and Sumitomo Mitsui, with AI companies to build this autonomous financial infrastructure.
It feels exactly like watching two different construction crews at work simultaneously. One crew, the legacy finance managers, is frantically trying to patch potholes on the old highway, dealing with inflation, bond yields, and T+1 settlement delays. Meanwhile, the second crew is quietly pouring the concrete for a brand new, completely frictionless bullet train system right next to it.
And that second crew heavily includes major corporate treasuries, who, by the way, are reacting to this price volatility very differently than retail traders.
Let's look at the entities actually taking advantage of the ETF-driven price drops, because the corporate disclosures detailed in the reports were highly revealing. We saw a registration statement for SpaceX.
Right, the S1.
Yeah, which, for those unfamiliar, is a mandatory financial disclosure offering a rare, transparent look at a private company's balance sheet. It disclosed an 18,712 Bitcoin treasury.
With an average cost basis of roughly $35,320. I mean, that is a highly profitable reserve for an aerospace company.
Yeah, no kidding.
It really indicates that frontier technology firms view this asset as pristine reserve collateral.
But the most aggressive maneuver definitely came from Strategy Inc. They purchased an additional 24,869 Bitcoin, pushing their total corporate treasury past 843,000 coins.
Which is roughly 4% of the total terminal supply of the asset.
But I have to ask, isn't hoarding 843,000 Bitcoin on a corporate balance sheet during a macro downturn insanely reckless? Like, what happens if the price halves tomorrow?
Well, if you view them purely as an operating software company, it looks like an astronomical risk. But you have to look at the corporate finance mechanics they executed alongside the purchase.
What do they do?
They repurchased $1.5 billion of their own convertible debt at an 8% discount.
Break down what convertible debt is and why buying it back neutralizes their risk.
Sure. Convertible debt is basically a type of bond a company issues to raise money, which can later be converted into company stock.
Okay.
In a high interest rate environment like we're in right now, when old debt matures, refinancing it with new debt is incredibly expensive.
Because the rates are so much higher now.
Exactly. So by using their capital to buy back their own debt at a discount before it matures, they eliminated the risk of having to refinance at today's punitively high interest rates. They strengthened their balance sheet, lowered their debt burden, and simultaneously accumulated more of the underlying asset.
That is balance sheet optimization at the absolute highest level. And they aren't the only ones doing this. The filings show smaller entities making permanent allocations as well. We've got Strive Inc. buying over 380 coins, DDC Enterprise adding 200, and a French data intelligence firm called Capital B buying 192 coins.
Yeah, so they clearly view the asset fundamentally differently than an ETF retail buyer who just panics when oil prices spike.
Right. An ETF buyer, broadly speaking, is playing a quarterly yield game. They are managing fiat performance month to month. But these corporate treasuries are playing a multi-decade infrastructure game.
Exactly. They are acquiring pristine collateral to survive a sovereign debt crisis, not trying to beat the stock market next quarter.
And that long-term view brings us to the most mind-bending piece of infrastructure in the source material today, the application layer. We are talking about the BUY 402 protocol. Coinbase just donated the open-source BUY 402 protocol to the Linux Foundation. Explain to us what this actually does, because it sounds like deep internet plumbing.
It is. So in the original architecture of the internet, developers created status codes to standardize communication. Everyone knows the 404 not found error, right?
Sure. Yeah.
Well, there was also a code created in the early days called HTTP 402, which stood for payment required. It was designed for native internet transactions, but it failed to gain traction because, well, we didn't have a digital frictionless currency at the time.
We had to rely on clunky credit card networks.
Exactly. And those networks charge high flat fees that make microtransactions completely impossible.
Right, because you can't swipe a Visa card for a fraction of a penny. The fee would eat the whole transaction.
Precisely. So the BUY 402 standard revives that payment required code using something called ERC20 Permit 2 architecture.
Okay, another highly technical term. What is Permit 2, and how does it bypass the old credit card rails?
Traditionally, on a blockchain, a user has to manually sign and pay a network fee for every single transaction they approve. It's slow. Permit to is a smart contract mechanism that allows a user or a program to grant permission once.
Oh, interesting.
This allows funds to be moved securely in the background without needing a manual signature every single time. What it fundamentally allows is for artificial intelligence programs to execute sub-cent stablecoin payments autonomously.
Autonomously, meaning absolutely no human intervention, no credit cards, no bank approvals, no user click and approve on a wallet extension.
None of that.
Just a machine paying another machine for data or resources instantly for fractions of a penny.
It provides universal monetization for application programming interfaces, or APIs. An AI agent can browse the web, hit a paywall for a specialized academic dataset, instantly stream 1/10 of a cent in digital dollars to unlock the data, and just continue its task without ever pausing to ask a human for a credit card.
That is just staggering to think about. It is literally the foundation for an agentic machine-to-machine economy.
It really is.
But, we have to remain analytical here, and it's not all frictionless progress. The source material also highlighted some severe infrastructure churn, specifically regarding the physical bridge to these digital systems.
Yeah, the ATM situation.
Right. Bitcoin Depot, which operates physical automated teller machines, filed for Chapter 11 bankruptcy.
They're shutting down 9,700 physical machines globally. And the filings explicitly cited state-level compliance mandates and transaction limits as the primary factors that destroyed their business model.
So the regulations literally killed the physical access points.
Yeah. It serves as a stark reminder that while the purely digital protocol layer, things like BY402, is expanding and succeeding beautifully, the physical bridge attempting to connect legacy fiat systems to digital assets remains incredibly fragile and expensive to maintain.
So to synthesize the data we've covered today, in the week that was, what we're looking at is essentially a tale of two distinct markets operating in the exact same space. Short-term price action remains entirely tethered to legacy macroeconomic plumbing.
Completely.
If a geopolitical crisis flares up, if inflation spikes, or if Moody's downgrades sovereign debt, the bond yields rise. And when bond yields rise, that macro vacuum cleaner turns on, triggering algorithmic sell-offs and retail liquidations.
But the underlying network adoption is completely decoupled from that surface-level panic. Sovereign entities are drafting 20-year lockups and stablecoin blueprints for AI economies. Corporations are neutralizing their debt risks and accumulating massive treasuries. The digital infrastructure itself is hardening.
And that leaves me with a final thought for you, the listener, to mull over as we wrap up this deep dive into the source material. We have spent this entire conversation analyzing how human behavior, inflation, anxiety, margin calls, geopolitical panic dictates market pricing. But with the deployment of the BY402 protocol, we are standing on the edge of an era of machine-to-machine economies.
It's a totally new paradigm.
It is. If we have millions of AI agents autonomously streaming fractions of a cent to each other every millisecond, in 5 years, will the digital asset market even care about human panic? Or will the primary economic actors be AI agents completely immune to human emotion, executing millions of microtransactions entirely unbothered by what the bond market is doing? When you look underground at the foundation, the steel isn't just holding firm. It's learning how to build itself in ways the old architects haven't even realized yet. Thanks for joining us on The Week That Was. Stay curious, keep questioning the surface-level narratives, and we will see you next time.